Today's a day to buy the dip. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Cloudy outlook today. Oracle's results reignite concerns over tech valuations and the AI CapEx spend.
Meanwhile, Lilly gets a boost. A study shows that its experimental obesity shot may be the most potent weight loss medicine yet.
And growing dissent at the Fed hints at trouble in 2026 when a new chair may find consensus even harder to marshal.
It's the push and pull. What's more important for this market? Is it the Fed? Is it Oracle earnings? At least for this morning, Oracle Matt is really dragging at least tech stocks down with it. They're off 13% in the pre-market, so it had disappointing cloud sales, a jump in data center spending, all of that adding to concerns that you're spending more. I think their figure was, $50 billion, and they're not having the revenue to back it up.
Yeah, exactly. They're apparently the bellwether of this AI debt and spend boom. We're going to be talking a lot about Oracle today. Eli Lilly's next obesity shot helped people lose 23% of body weight in a late-stage study. And a lot of people quit the study because they were losing too much weight. So Eli Lilly shares right now up 1%. And if you look at, I'm sure at some point today we're going to look at Eli Lilly versus Novo Nordisk. It's just shocking how badly the pioneer in weight loss drugs has done.
Yeah, it's true. The competition really is on for them. We have a lot to discuss in AI, and we begin with that with Bloomberg Tech co-host Caroline Hyde. Caroline, some Disney breaking headlines, which maybe we can get to in a moment around AI. But first, let's start with Oracle. And maybe the big disappointment. I mean, shares are down a pretty hefty amount in the pre-market this morning.
Yeah, is Oracle more important than the Fed? It suddenly feels as though that AI anxiety, but the debt load anxiety is coming back to the fore. But this is a company that is going to be having there's such a significant amount of debt. $50 billion of capital expenditure is what they're now signaling for the fiscal full year. $50 billion is basically 3/4 of their entire annual revenue. So if you're thinking and worrying about Meta, they only have about 1/3 of their capex is attuned versus their revenue. This is a company that has $100 billion of debt. They say they're committed to keeping an investment grade, but more broadly, their credit default swaps, the cost of insuring their debt right now is spiking to the highest we've seen since 2009. They have a huge backlog. The order backlog is absolutely extraordinary, more than $500 billion. But how much is real? And many are wondering, you've got too much focus and exposure to just OpenAI, which has $300 billion worth of those orders. How much is becoming real revenue today? Look, revenue looked good. We saw cloud perform particularly well, up more than 30%. You saw the fact that their infrastructure part is growing whopping almost 70%. But people need more tangible money coming in tomorrow rather than in a year, in 2 years' time. It feels as though analysts are out there saying it doesn't look that bad. But investors seem to have this unrealistic perspective of how quickly they can mark down revenue at the same time as they're spending on infrastructure, on real hardware and equipment. They're not saying this is on land, this isn't on data centers that they can't yet use. This is on equipment that they're using today and really returning for them. But it wasn't enough to appease the market anxiety.
You know, I'm seeing some strange headlines on, or just the juxtaposition of the two big stories for OpenAI, right? On the one hand, Microsoft and OpenAI are being sued for a murder-suicide in Greenwich, Connecticut. On the other hand, Walt Disney is going to make a $1 billion equity investment in OpenAI, saying Disney wants to bring its beloved characters from across Disney's brands to Sora. I guess the Disney story for now, because the lawsuit obviously is an allegation, and OpenAI said they're going to look into those. We don't have many details. But the Disney story for investors has to be the more important one, right? I mean, $1 billion investment from this iconic, from the House of Mouse in OpenAI. Is that a vote of confidence?
There are two stories that are very hard to put in the same sentence. So let's focus in more on what's happening with Disney right now, because they say they're the first major content licensing partner on Sora. Now, it's interesting that they're going on Sora because many would say that at the moment, OpenAI's focus is on making image creation really easy on ChatGPT. Maybe they put Sora a bit on the back burner as they integrate image generation into their main core offering, because that is where Gemini has looked so strong. And that is actually where a lot of people are taking up their time on these so-called AI chatbots. the professionals here are using it for productivity, but most of society loves creating images, and no wonder Disney wants to make sure that their IP is at the heart of that, and of course that they're getting recompensed for it in some way, but they're seeing the upside of OpenAI's growth and image generation growth. So really notable that they're putting in $1 billion equity.
Wasn't there like a whole strike over this, though, a whole Hollywood strike to try to avoid this sort of thing of AI being the thing to produce all these images and short form content for Disney?
The strikes were over many things, and in terms of the way in which labor was treated, but bolted onto that whole anxiety and worry was indeed, what's the future of artificial intelligence? I've almost felt like that has moved to the wayside in many ways. It's become inevitable. Netflix is using generative AI within production. We're hearing companies more and more turning to a Runway, which is a New York-based image generation company, which has got one of the best image generation models out there if you're looking at the leaderboards. There has become a tussle among just many creativity focus here is that actually humans are still needed in the loop. If you're going to make really iconic IP such as Disney, it's going to be needing a human there to create it. But if you want to then be leveraging that IP and building into your image going forward, you probably want to have access to Disney, and Disney wants access in return. But yeah, this is going to have a lot of intricate messaging for its workforce, I'm sure, as to how important they still are.
All right, Caroline, a lot to dig into with Walt Disney, with OpenAI, with Microsoft, with Oracle as well. We look forward to Bloomberg Tech. Caroline Hyde co-hosts that show with Ed Ludlow. They kick it off at 11. I want to talk, though, a little bit more about what people are using AI for. Is it really going to drive productivity, or are you just going to put together pictures of mice? And I think
mice or mice?
No, like Mickey Mouse.
Okay, I didn't know like real life. Okay, got it.
So I think it's interesting to marry this story with the Fed, because I actually heard Robert Kaplan on Bloomberg Radio talking with Tom Keene a moment ago saying that he thinks productivity could be boosted about a 0.5 percentage point in 5 years. That doesn't seem like a massive move to me, and maybe it's because people are just using AI for image generation. Let's get to Mike McKee right now. He's here to talk to us about what we heard yesterday from the Fed. Obviously, there was a cut. It doesn't really seem to be moving markets much. It's not like bond yields have come down, right? We're still at 4.12 on the 10-year. What do you think about the AI aspect? Because people like Austin Goolsbee brought it into their dissent.
Yeah, Jay Powell was asked about it, and basically he's saying there may be some signs of it in the economy, but it's really hard to pick out right now. And most people will tell you that they're not anticipating major changes in productivity for a while yet, because it takes a while for businesses to figure out exactly what it is that can be done and can be done more efficiently using AI. So it'll take a while for things to be adopted. Maybe not as long as it did for the personal computer, and certainly not as long as electricity, but it's not going to be something that happens overnight.
Wait, did that take a long time, the adoption of electricity?
In terms of having a big impact on society, is about 50 years. Wow. So, I mean, you aren't even 50 yet, so you can't even conceive of that time period.
If we take a step back, Mike, and just the overall Fed decision, because the big broadcast or the big takeaway for many was the dissents. And Chair Powell tried to describe it as, look, it's a confusing picture. Our mandates are intention. So, of course, you're going to get dissents and other ways to frame it. Is that what's happening? Or does it say something about 2026 and what the composition and the makeup and the dissents among the FOMC will be going forward?
Well, it's a little bit of both. I mean, when you look at the overall bottom line here, you've got Jay Powell and those who voted for a cut placing a big bet on the idea that the Trump tariffs are going to go through the inflation economy and then out the other door before the end of 2026. And then you have the dot plot where they're only going to cut once. So you have this division among the Fed officials about what's going to happen. And so it's going to be hard for any single person to come in, a new chair to come in and get the whole committee to go along. But we don't have all this data that's going to start coming next week. And so I would say this has a very short shelf life, this meeting, because everything's going to change, and we're going to get all kinds of new views on the economy and what's going to happen.
All right.
Yeah, Mike, thank you very much. Should be interesting to see how it shakes up next year. Michael McKee on the latest Fed decision. Elsewhere, in the next generation obesity shot by Eli Lilly helped patients lose almost a quarter of their body weight in a recent study. The drug was so effective that some patients dropped out of the study because they lost so much weight. Bloomberg health reporter Madison Muller joins us to explain. Madison, just how big of a step up is this in progress for these weight loss medications?
Yeah, this is a huge step up. That's exactly right. I mean, this is the next wave of therapeutics, the next generation of drugs that are, the drug makers were hoping were going to be even more effective than the currently available medicines, which are Wegovy and Zepbound. And already those drugs work really well. I mean, in a lot of cases, Zepbound can, help patients lose up to 20% of their body weight. And so that was sort of the bar for where these next generation drugs had to get higher than that in order to be considered successful by investors and by the companies who have set sort of a high bar for themselves. And so we have seen Lilly and Novo Nordisk, their rival, trying to develop these next generation compounds. Novo's really struggled with that, but this is the first time that we're seeing this late stage phase 3 data from Lilly's next generation drug, and it's really, exceeding what investors had hoped for it.
We just showed the chart I was referring to at the top of the show, the stark divergence of Novo Nordisk stock to the downside, Eli Lilly stock to the upside. Is, the market share picture this bad? I mean, I thought, it was hard to get Zepbound at CVS, for example. So everybody who's going through that gigantic pharmacy benefits manager has to go with Wegovy or Ozempic. Why is the stock split so much?
Yeah, I mean, in terms of the market share, Lilly has pulled ahead of Novo. So Lilly's drug Zepbound is the most popular weight loss medication on the market right now. But a lot of this is also due to anticipation about what comes next. I mean, Lilly and Novo actually both have weight loss pills that are expected to launch probably next year. Novo's could launch by the end of this year. And those drugs are, pretty similar. But in terms of what comes next, in terms of these next generation therapies that are maybe more effective or have fewer side effects, Lilly is really excelling there. And they've had success after success with these, even earlier stage molecules like amylin, which has potential to have less side effects. And Novo is just continuously falling behind there. We also saw Novo lose out in that bidding war with Pfizer over Metsera, which could have given them access to some more next generation compounds. So there's just a lot going on at Novo. I mean, even when we look at CEO turnover, layoffs, various things going on there where Lilly's not having those same challenges.
Hey, Madison, thank you very much for that. That's Bloomberg's Madison Muller. Let's get a quick check on futures this morning because yesterday's rallies turns into today's losses after Oracle earnings where revenue came in lighter than expected and spending on AI higher than expected. NASDAQ 100 futures lead the declines down 0.5%, down a third for the S&P 500, while the Russell 2000 outperforms only down 0.2%, Matt.
Let's get a look at some of the single stock stories we're watching this morning. Disney is going to make a $1 billion equity investment in OpenAI. It will also become the first major content licensing partner on Sora, which is OpenAI's short-form generative AI video platform. That's a mouthful.
That is.
It's interesting. That's what people, I guess, are going to be.
The thing I don't get about this is, okay, yeah, Disney owns the IP, but anybody can make a video on Sora, and anybody can put content out there.
Yeah, but you can't do it with Mickey Mouse, right? If you try and use trademarked content on OpenAI, it won't let you.
You could do it with Winnie the Pooh. He's now in the public domain. Yeah, so that's something for you. By the way, speaking of AI models, Microsoft's planning to unveil a new one on Friday. It's going to, quote, take agents to the next level. That is, according to the CEO, Satya Nadella.
Did not know that about Winnie the Pooh.
Yeah, it's in the public domain now.
Coca-Cola's CEO, James Quincy, is stepping down and will be replaced by the COO, Enrique Braun, at the end of March. You can see Coca-Cola shares up a third of 1%.
And Altria CEO Billy Gifford has decided to retire. That will be effective in May. CFO Salvatore Mancuso will take over in his place. Shares up just a third of 1% this morning.
All right, coming up, it is not just President Trump weighing in on the Warner Brothers deal. Democrat senators are also raising concerns as the media merger draws the attention of Washington, D.C. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. Mexico has approved sweeping new tariffs on over 1,400 Asian imports, aligning itself more closely with the U.S. Pressure on China as President Claudia Sheinbaum aims to shield her local industries. Starting next year, duties of 5 to 50% will hit goods from clothing to auto parts, including steep 50% tariffs on Chinese cars. Beijing has warned Mexico to reverse what it calls protectionist measures. American Airlines says bookings are rebounding after the shutdown that costed up to $1 million a day. CEO Robert Isom expects a strong start to 2026 thanks to resilient travel demand and a push into premium cabins and new long-range jets. He spoke exclusively to Bloomberg's Lisa Abramowitz.
Whether you're more economy-focused and budget-minded or you're premium services, everybody wants more. Everybody wants better control. Everybody wants more comfort. So I don't think that there is going to be any going back in terms of offering product at any level of the spectrum of offerings. But for us, as we go forward, you'll see us with our lie flat seat offering. That's going to grow by 50% over the next few years. Premium seating, 20%.
And speaking of airlines and the premium experience, JetBlue is opening its first ever airport lounge, the Blue House, at New York's JFK next week. The space targets premium flyers and card holders as JetBlue shifts towards higher yielding travelers after a tough year. It joins a broader industry push to woo an affluent customer, as you just heard there from Isom, with a second Blue House planned for Boston in 2026. Lisa will sit down with JetBlue's CEO, Joanna Garrity, at the ribbon cutting at JFK on Tuesday, Dani.
It's about time. It's like a good reason not to fly JetBlue for business if you don't have a lounge. Like, you need to go to a lounge and get work done.
But everybody goes to the lounge. Like, the lounge is packed.
No, it's true. But, I mean, in JetBlue, you don't even have a lounge to go to. So it's, you know, a big thing for them to get one in JFK. By the way, Matt, we're also still monitoring the battle for Warner Brothers Discovery. They're carving up the country along political lines. Some Republicans are rooting against Netflix. Democrats have concerns about Paramount's bid. All of that comes with the president making a demand regardless of who the winner is.
I think any deal should be guaranteed and certain that CNN is part of it, or sold separately. But I don't think the people that are running that company right now and running CNN, which is a very dishonest group of people, I don't think that should be allowed to continue.
Joining us now is Bloomberg executive editor of tech coverage, Michael Shepard in Washington. Shep, the president's specific focus on CNN, is this just not another win in Paramount's direction, with the Ellisons promising that they would make changes to the company and to the news programs?
You know, Dani, on one level, it certainly would suggest that the president is tilting in that direction. And yet he has also said that neither Netflix nor Paramount are particularly good friends of mine. He said that very much shortly after he made that comment about CNN. So we are not seeing him necessarily putting the thumb on the scale either way. On Sunday, he did say that he thought that the Netflix proposal looked problematic. He said that he also may even get involved in the review process, which would be unprecedented. We typically do not see presidents weigh in either way when it comes to mergers and acquisitions, even big ones, unless there is some serious national security element involved. Well, so we'll be watching to see just how much more he gets involved in this one.
Unless it's the Trump administration, right? Because President Trump was solidly against, in his first term, the AT&T purchase of these very same assets, Warner Brothers Discovery. And while his thumb may not be on the scale, he does want CNN to be included in the sale. That's part of the Paramount deal, not the Netflix deal. And his son-in-law is helping to finance the Paramount deal, and his friends in Saudi Arabia are also helping to finance the Paramount deal. And of course, Larry Ellison is someone that he's very close with in terms of the whole Stargate project. So I don't know if his thumb isn't on the scale, but it does seem like it could go in one direction rather than the other.
It does argue in that direction of travel, certainly based on those alliances. And Paramount has been quick to point out that, A, they think their deal is stronger overall, perhaps because of the inclusion of the TV networks, but also because they think they will have an easier time when it comes to regulators in Washington. And David Ellison has pointed repeatedly to this close relationship with the Trump administration. And his father, the world's second richest man, has long been an ally of the president, going all the way back to the first administration. And of course, now his Oracle Corp is playing a central role, not only in the AI rollout here across the U.S., but also in the TikTok deal that the president is trying to get over the line. So there is a lot at play here behind the scenes, as well as in the merger review process. We do see Democrats and Republicans kind of breaking down their concerns on different lines. We saw a letter from Representatives Sam Liccardo and Ayanna Pressley, both Democrats, expressing concern about the influx of Mideast money on the Paramount side. And then we saw Darrell Issa of California, a Republican, expressing concern in a letter to Pam Bondi that, hey, this Netflix tie-up really might concentrate the streaming market. And that's something we've talked about in this space before, that would really join Netflix as the #1 streaming provider with HBO Max, the #4, and perhaps create a market concentration. And that is something that the president also has singled out, saying they may have a problem when it comes to market share. So we'll want to be seeing how this breaks down. If you ask Elizabeth Warren, though, she'd be happy with neither deal. She sees Paramount as an antitrust five-alarm fire and the Netflix deal as a monopoly nightmare. So let's see how this plays out. We'll have it for probably another year or so.
Yeah, what a saga, literally from any angle you slice it. Shep, thank you so much. That's Michael Shepard. On the latest on the Paramount Warner Brothers Discovery Netflix deal, you're watching Bloomberg TV.
Check on futures ahead of the opening bell. We're looking at losses. Remember, we closed up yesterday, so breaking the streak, but we're back down after Oracle earnings. Coming up, Morgan Stanley's Jitania Kandhari joins us in studio to talk tech volatility and how tariffs are reshaping the U.S. economy. This is Bloomberg Open Interest. We are moments away from the start of trading on this Thursday. This is Bloomberg Open Interest. I'm Matt Miller. Oracle earnings yesterday after the bell, dragging us down. At one point, Oracle shares were down 12% in the pre-market. However, that has brought in dip buyers. And the question is, if it can move Oracle higher, can dip buyers move the rest of the market up as well? Of course, we did have a Fed meeting, and a lot of what are being called silent dissents may worry people in terms of cuts. Opening bell at the New York Stock Exchange, the CEO of Time Magazine, they're ringing the bell. They've been a pretty frequent guest at the New York Stock Exchange in this administration. Love the red coats. Down at the NASDAQ marketplace, we have Luxema Imaging ringing the opening bell, and the CEO, who you can see right here front and center, is going to join us on Bloomberg Open Interest in just about 1 hour's time. So stick with us for that. In terms of the stocks to watch, you know what? My eyes deceived me.
Oh, because Oracle was up yesterday.
I saw yesterday's cash trade in Oracle with a green arrow, and that made me think, wow, the dip buyers are coming in, but they're not.
Yeah, but that also reminded me, I want to talk about this at some point. There's a really interesting AQR study that dip buying actually doesn't work. It doesn't work as just buying and holding, because stocks have momentum. So if you're an Oracle and you're down like 15%, odds are it's going to keep going down. So dip buying isn't the best strategy. So, okay, to recap Oracle, earnings were disappointed, cloud sales weren't as great, and on top of that, a huge jump in their data center spending, $50 billion, 15 more than had originally been announced in September. All of that adds to concerns that it's going to take longer to see returns on its AI bets. In other AI-related things, Disney is also making a $1 billion equity investment in OpenAI. It's going to become the first major content licensing partner on Sora, so those shares up 1%, Matt.
All right, that's a fascinating story that we're going to dig deeper into. Also, Eli Lilly's next obesity shot helped people lose 23% of body weight in a late-stage study. And it may have been even more, because apparently some people were losing so much weight that they quit the study. As a result, the shares are up 2%, and it's pretty shocking to see how far Novo has fallen. At some point, they're going to come out with a shot that helps you lose 100% of your body weight.
So you just disappear.
Yeah, exactly. Just fade
into
away.
exactly. Like a Harry Houdini magic
Like
trick.
a Homer Simpson just backing up into. All right, turning back to the AI trade, because that's what's obviously moving markets along with the Fed. Oaktree's Howard Marks addressed bubble fears on Bloomberg Surveillance this morning.
There are bubbles which are based on technological progress, starting with the steam engine, the railroad, the radio, the automobile, computers, internet, et cetera. And these actually push society ahead and change it irreversibly. But in the process, there's a bubble surrounding their implementation, which is overly accelerated and overly financed.
Let's bring in Jitania Kandhari, Deputy CIO of Solutions and Multi-Asset at Morgan Stanley Investment Management. Jitania, great to have you here on set. Thanks for joining us. What do you think about the bubble argument? Because I heard someone today say, you know, there's maybe a funding bubble, but it's not about the fundamentals of the use case.
Yeah, so I think there are cracks developing in the AI, I mean, not bubble, but in the AI story, but there are some redeeming factors as well. The cracks are clearly, as Oracle has demonstrated, you know, the funding, the circular funding, and I think most importantly, the adoption versus the monetization. Is that moving in sync, right? OpenAI has recently said that less than 10% of their actual users are subscribers. So where is that monetization going to come from? So I think those are some of the questions. In terms of the redeeming factors, let's remember AI is a sovereign focus for many countries. There will be momentum and push behind it. There are earnings. Some players are going to emerge successful. But I think we really need to start discerning between the infrastructure, the platform companies, and the application layer, and who in that value chain will be the winners from here.
What about within those, what asset class you play this through? Howard Marks, when he was speaking with Lisa earlier, said that equity might be better than debt. We've seen concerns around the debt, be it in private credit, be it the CDS. I mean, usually you'd think debt, it's safer, you're higher up in the capital chain, maybe that's where you should play. Is there an element that maybe this time around the equity makes more sense to own than the debt portion of some of these companies?
I would agree, but I think, you know, a structural theme, it needs the confirmation test from multi-asset, right? You really need to be able to play it through the different assets. So yes, private equity is one very important area because a lot of that growth venture kind of investment biology, like I think from code to sell, that's the next frontier. You can now program biology, right? Compared to the past where you could software programmers could just code. So all of that innovation is also happening in the private space, especially in companies that are growing ground up from AI, where they have no legacy infrastructure, legacy workflows, but there is a lot happening even in the private space. So yes, equity looks great, but even on the credit side, great fundamentals. You really need to be discerning at this stage of the cycle.
Last month, I turned 52.
Great.
And thank you.
Happy belated.
And I got a number of gifts, packages sent to me from Germany and from the UK that were either returned to sender or that the post office in that country said don't even bother because it won't get through. If this is happening to me, I can imagine that it's happening across the economy, right? Maybe not at the enterprise level, but in terms of packages being shipped to the US. Do we have a problem?
I think we have an issue with the current tariff policy. Firstly, the world is organized by sectors, and the current policy is targeting countries. So I feel that's like a disconnect, right? You take an EV battery, lithium from Australia, refined in China, nickel from Indonesia, processed in Nevada, finally. I mean, there are multiple global routes that a particular product takes, and we are trying to target a single country in that chain. So it'll just expose critical dependencies, bring costs up. And I think what US is missing is that a large part of the US imports are intermediate goods. 50% almost. Why do we need these intermediate goods? Because our manufacturing stock is depleted. So if you want to really start bringing manufacturing back in the US, you need the capital stock, which equals these intermediate goods, and you're taxing them. So it's a tax on domestic production. So I think that's the issue. And just to kind of add another layer of complexity is US imports highly complex goods. machinery, electronics, pharmaceuticals, auto parts, they're not easily onshoreable or reshoreable. You really, and on the contrary, we export very simple goods like natural gas and soybeans, which can be substituted by other countries, like Brazil is buying, like China is buying soybeans from Brazil now. So I think there's a flaw in the overall tariff policy framework, and we will hit many hiccups like this till there's realization, which is always already happening with all the backtracking that we are seeing with different sectors.
Jitania, you need to come back because we're out of time, but this is so interesting. We could spend like a whole hour talking about this. Thank you so much for joining. That's Jitania Kandhari of Morgan Stanley. A quick check on your equity market this morning. You can see their small caps doing better, but how is the S&P doing? It is not. It is down 0.33%. Financials are doing pretty well today. Visa at the top. MasterCard, Visa got an upgrade today. JP Morgan, Eli Lilly also having a good day. We pointed out that their current or their latest weight loss medication, 23% of body weight, zapped, disappeared. People stopped taking it because they were losing too much weight. To the downside, Oracle, even though it's one of the biggest losers, down 14.5% after their earnings disappointed. They're spending more. It's Nvidia that's dragging the overall index down just because of its heft, its weight. Broadcom also down 2.3%. We're going to get earnings from them. Can they turn things around? Can it save the narrative? If you look at the sectors, it will be no surprise we're going to get financials high up and tech low down. So financials, the second best performing index this morning, up about 0.9%. And infotech, yeah, that's Oracle. Oracle dragging the whole thing down, Matt. It is down 1.4% in what's set to be a down day after the Fed lifted overall markets yesterday.
All right, so an interesting move and pretty shocking to see Nvidia down 2.7%, really dragging down the index. Coming up, Disney strikes a deal with OpenAI to bring its iconic characters to Sora. That's apparently an OpenAI-like video platform. More details on it next from someone who knows more about it. Caroline Hyde joins us again. This is Bloomberg Open Interest.
Let's look at some of the top calls this morning, what analysts are saying on Wall Street. First up, Deutsche Bank. They've downgraded Union Pacific. Deutsche Bank argues that despite two strong quarters, shares may stay sluggish if opposition intensifies around Norfolk Southern's potential merger. Those shares down 0.6%. Next up, Boot Barn. That gets a new buy at Goldman Sachs. Goldman rolled out coverage of the apparel retail sector with preference for store growth and pricing power. Shares up 3.33%. Finally, Oracle's weak cloud outlook and the huge amount to spend. That's sharpened Wall Street's worries about supply constraints, that they're slowing its ability to turn in a swelling backlog into real revenue. Morgan Stanley flagged falling confidence that Oracle can convert its expanding commitments into durable cash flow. So shares of Oracle, Matt, off nearly 14% in this early trade.
Wow. I honestly, I read a story this morning saying that we would see dip buying, and that was at 12%, but it continues to fall. Let's get back to the news that broke at the top of the hour. Disney announcing a $1 billion equity investment in OpenAI, which includes a licensing deal to allow its iconic characters on Sora. Joining us now is Mandeep Singh, Bloomberg Intelligence Global Head of Technology Research. And I would have thought that OpenAI would pay to use Disney characters on its platform, but Disney is paying OpenAI to use its characters on the platform.
Yeah, look, you're right. I think intuitively that should have been the case, but all these large language models already have a lot of IP, when it comes to companies like Disney and other companies, because that's what they were trained on. Now, what Disney is doing is really making sure that, they use some of these AI tools to augment their own artists and creators in terms of, content that is based on Disney characters. And a partnership.
Wait, isn't that precisely what they're not supposed to do? Isn't that what every media company is currently promising all of its employees and the entire creative community that it won't do?
At this point, they will be looking for productivity tools to, increase the speed of content creation. And in this case, I think they are better off picking one model provider because otherwise it gets commoditized. If, let's say, Gemini has it, Anthropic has it, Meta has it, then what's the value of your IP? At least they're saying, we will allow OpenAI to use our IP, and really we'll build off of that partnership in terms of the derivative content. Now, this kind of restricts Anthropic, Gemini, and Meta from using Disney IP in one way.
Isn't there some element that for these media companies, they're confronting a world where tech has just allowed an insane amount of content? And content that looks, I mean, it's still not completely there yet, but content that looks a lot better than what they could have done, and it's done more cheaply.
Yeah.
Are companies like Disney just trying to get ahead of that, of what likely is just an explosion of user-produced things, maybe not with Mickey Mouse, but apparently Steamboat Willie is in the public domain, so maybe with Steamboat Willie out there?
Yeah, I mean, look, what social media did to a lot of print newspapers and all the traditional, media. So from that perspective, partnering now at an early stage when all these model providers are trying to get to AGI, and look, the way images are trained, there's something called a diffusion model. It's different from the way text is trained, which is an autoregressive model. So the reason why Gemini 3 got so much better is because Google had a lot of their own content from YouTube and from their own repository. That's what made Nano Banana so good compared to other models. So that's, I think, what OpenAI is trying to catch up on in terms of getting someone like Disney to share their content, because as I said, the diffusion models are trained differently, the set of tokens are different, and so getting that Disney IP could make a difference in terms of how they train their model.
By the way, just on the horse race, which one is better than the other? I feel like you wouldn't say a 911 is better than an F-150 because they're different tools. They're for different purposes. I switched over to Gemini 3 from ChatGPT, and I found it didn't work for my use case. I wasn't doing Nana Banana, whatever that is. And I'm not doing Sora, right? I'm just asking for research. These things are better at very different things than each other.
And the reason for those differences are now the way they are trained, the way reinforcement learning, and a lot of these techniques are getting applied, which is really saying, I've got this unique data, I'm gonna fine tune my model on this unique data. I mean, all these models were trained on the same open internet data. Then how did they keep building their differentiation? And Anthropic is a good case in point where they really doubled down on the coding agent use case. Well, they focused a lot on code generation, and they kept fine-tuning their model on that, and now everyone is trying to catch up to them on coding agent. So you really got to find your niche in terms of fine-tuning and make your model better that customers will be willing to pay for it. And in Anthropic's case, they have. So same thing with Google Gemini 3. It's gotten so much better in image generation that people are preferring that. And I think this is Disney's attempt to catch up to Anthropic on the coding agent side and Google on the image generation side.
Unless Google just forever makes it free and bleeds everybody else out.
The pricing part will still remain. How do you monetize Disney's IP in the case of OpenAI? Sure. But still, I think content generation and the quality still matters when it comes to the use of these LLM tools.
Mandeep, thank you so much for joining us. That's Mandeep Singh of Bloomberg Intelligence. Coming up on the show, Eli Lilly's new obesity shot is so effective that some participants had to drop out of the study because they lost so much weight. Shares were initially higher. Now they dip in this morning's trade. We'll have that coming for you next.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in the stock market. We have the S&P 500 now down 0.6%, erasing almost all of what we gained yesterday at the close. The Nasdaq down 1.25%, a little bit more than 1.25% right now, and this because not only of what we saw with Oracle's earnings and CapEx spending plans, but also the weight of Nvidia. Check out that stock right now down 3.25%. so it's going to be taking at least 15 points off the S&P 500. Oracle is down 14%. So investors are selling the AI trade, the data center trade today. Bitcoin is also down 2.8%, under $90,000. That's dragging down Coinbase. Novo Nordisk actually gaining a little bit. This is interesting because Lilly has a new drug that allows you to lose, in its latest trial, I guess, 23% of your body weight if you're the right candidate. And Novo's stock has drastically underperformed Lilly, but a little bit of a flip in today's trade, Dani.
Yeah, I wonder where that's coming from. But just to underscore what you're talking about, Matt, their new obesity shot, people lost 23% of weight in a recent study. It was so good that people dropped out of that study. Bloomberg Intelligence senior pharmaceutical analyst Sam Fazeli joins us. And Sam, what we're looking at is what Matt was talking about. The underperformance of Novo Nordisk is so bad. It is back at 2021 levels after losing 50% this year. It's essentially trading at where it was before the whole weight loss craze. The success of Eli Lilly and the advancement of their medicine, surely things just continue to get worse for Novo.
Yeah, I mean, the point is, though, that you look at this valuation that Novo has reached, and I think we talked about this a couple of weeks ago, too, that folks are beginning to say, you know, there are some analysts who are turning around saying maybe this is it. Maybe, as I think we saw some article today, that everything, all the excitement about obesity is kind of being wiped out of Novo Nordisk. So, but on the other hand, Lilly keeps coming up with these data sets that I have to say today's is a pretty good data set, and we can talk about that in a minute.
Let's talk about it right now. How's the data set look?
Yeah, so, excuse me. The nuances here are that this is in a very obese population, right? So I think Lilly's view is that we've got a drug here that's going to have a big punch. It's got 3 actives in it, right? Not just like Zepbound that's got 2 mechanisms, it's 3. We're going to have such a big punch, and of course they've shown that we're going to go for the very heavy patients, 35, BMIs of 35. So these are patients who also are suffering in this trial from osteoarthritis, and osteoarthritis. And what it's showing here is that if you started at such a high weight with this triple action, if you like, triple G it's called, you do get the weight loss that brings you down. But of course, when you start with an average weight of 200 kilos, 175 kilos or whatever, you have more to lose. And that's what we're seeing here.
Sam, what about the battle for not a shot, but for a pill you could take? Where does that stand? And does whoever get that to market first ultimately win out?
Yeah, so we've had some data from Structured Therapeutics earlier this week. Pfizer did a deal with a Chinese biotech, Yao Pharma, just a couple of days ago for an oral pill. So a lot of people are still trying to get these truly oral drugs, not just reformulated versions of the same molecules that we're using today. And that's where the next action is going to be. But I'm still convinced that a easy to take once a week drug, which is what Zepbound and Wegovy are, is not really that much of a hurdle for patients. As we can see, people are taking it. More issue is manufacturing. Can you make enough of it?
Got a letter, a note, I should say, from a trader, just asking plainly, is it safe? You know, all this stuff. We don't know what the ramifications will be in 10 or 20 years, right?
No, but you do know what ramifications of having a BMI of 35 is. That you know for a fact, right? Yeah. You're not going to survive very long with that. You're going to have all kinds of complications. So you're going to have to trade the risk-benefit, as usual with any pharmaceutical.
Yep. Sam, great having you on the program. Really appreciate it. Sam Fazeli runs Bloomberg Intelligence for us out of Europe and the healthcare coverage there as well. Coming up in the next hour, BlackRock's Tom Becker walks us through the flows into riskier sectors of the market, and we dive deep into credit with SVP's Victor Khosla, plus the CEO of a company that IPO'd today, Luxima Imaging. This is Bloomberg Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Markets off to a negative start as Oracle earnings weigh on the overall indices.
Coming up, Bloomberg stylist indexes. Just so you know.
Thank you, Matt.
Coming up, Oracle shares fall the most in more than 24 years as the company's results revive worries about AI spending.
And weigh on tech indexes. Growing dissent at the Fed hints at trouble in 2026 when a new chair may find consensus even harder to cobble together.
Plus, the battle for Warner Brothers is getting even more political, with some Republicans rooting against Netflix and Democrats objecting to Paramount's bid.
We begin the hour with renewed AI bubble concerns. Oaktree co-chairman Howard Marks weighed in on Bloomberg TV.
There are bubbles which are based on technological progress, starting with the steam engine, the railroad, the radio, the automobile, computers, internet, et cetera. And these actually push society ahead and change it irreversibly. But in the process, there's a bubble surrounding their implementation, which is overly accelerated and overly financed.
Joining us now is Tom Becker, lead portfolio manager of the Tactical Opportunities Fund at BlackRock. And Tom, it does seem like there's so much cash out there that needs to be invested. We have seen spreads at historical tights for quite a while now that it would make sense lending standards could get a little bit lax or people could just be overly enthusiastic. Do you get that sense as well?
Yeah, Matt, morning. I think the enthusiasm is what we're focused on a little bit. So the dovish pivot to the Fed, and then I think, yesterday with balance sheet expansion, markets definitely like the looser monetary policy. But over the last 6 months, I think markets have been extrapolating some of the one-offs from the tax cuts in OBBA, some of the kind of leverage parts of the market kind of playing into AI and kind of second round effects and second order effects across different sectors. And so we've seen more of these leverage kind of speculative sectors of the market morph into momentum and get more well held. And that's when we get a little bit cautious. So over the course of the year, we've really round tripped in U.S. equities. We started the year short U.S. equities. And then, of course, you remember, like it feels like a long time ago, but DeepSeek, Liberation Day, those provide a real attractive kind of entry points into kind of what's a really legitimate earnings growth story. But here into year end, it feels like the risk return for kind of the broad U.S. market versus foreign markets just feels not as attractive. So we pulled it down to neutral.
You've pulled it down to neutral, Tom. What would make you want to go outright short again?
I think some of the kind of concerns that you're mentioning kind of overnight, where the kind of earnings story and how resilient the earnings will be. It's been interesting the last couple months that people have been focusing on the CapEx and the spend. Traditionally, that is a very bad sign for equities. So you tend to see overinvestment. You tend to see malinvestment. You've got half a dozen huge firms kind of competing and building kind of capacity. If only a handful of those, if only 2 or 3 are the winners, there's going to be overinvestment, and the earnings that can accrue from some of that investment is going to be a little lower than the market might be anticipating. So I think for us, it's going to be really about looking for selective opportunities. Europe has some great names. People have been missing that commodities have been quietly rallying these last 6 months. There are kind of some under-owned sectors of the European market in the UK and France, where we think we can get kind of attractive exposure to themes like that. So we're looking kind of beyond the AI theme at this point for other kind of things to start off 2026.
What do you like in the UK and France? I mean, these are economies that are problematic, but I long covered the FTSE, and it didn't really matter what was going on in the UK because all of those companies sell everything to the rest of the world, right? They're not just
right.
They're not just hawking their wares in Manchester.
Totally. And I think you've had a risk premium in both of those markets, Matt, like you mentioned. So the French government kind of earlier this year, kind of the worries about kind of borrowing in the UK this fall. And so that creates a little bit of a risk premium in the equity market that, like you said, those companies are not particularly tied to their domestic economies. And so you can get an attractive entry point to play things like the European fiscal emergence. So we're just starting to see kind of the German defense spending pick up. the end of kind of the Schwarz-Null, the kind of, debt break. And so this is going to be a multi-year theme. I think markets have priced it directly into kind of some of the German and Swedish markets and, directly into the defense heavy and industrial heavy parts of Europe. But you've got other names and other parts of kind of the larger commodity complex that had exposure in kind of other parts of Europe. So we're looking kind of for that attractive risk return in parts where we think it's less well held.
Well, the things that have worked well this year in Europe, it's been some of those defense names you talked about, Tom. The other one has been banks. And on that point, I thought this was interesting from Bloomberg Intelligence. They're out with a piece this morning saying that the bubble that nobody is talking about is not tech, it is banks. And they point to banks globally, that in Spain, Switzerland, Brazil, South Korea, that they trade 2 to 3 standard deviations above trend, despite earnings that are weaker than AI companies. Tom, is the banks trade, is it overrun at this point globally?
So we're not playing kind of at the sector level in Europe in that way. One thing that came out from our investor conference where we gathered last month, kind of in New York at BlackRock, the long run risk to maybe kind of the banking model of kind of the stable coins and kind of debanking kind of movements, people looking to kind of chip away at kind of the monopoly of fiat currencies and try to get into that space. I think that's a longer run structural threat. Whereas in Europe, I think the normalization of interest rates, kind of German long end kind of steepening out. You've seen this in Japan over the last couple of years. Banks like a term spread to kind of borrow short and lend long. And you've had that repressed for so long, particularly in these low nominal growth parts of the world. And so as we transition from kind of the savings kind of, the savings glut to maybe a savings deficit, and bond investors are asking for more compensation at the long end. They're doing it in Europe, and that's good for European banks that can kind of access ECB liquidity, but then make loans kind of at higher rates at the long end.
Tom, thank you so much for joining us. It is certainly a year that's felt like a decade. We look forward to doing it all over again and having you on in 2026. Tom Becker of BlackRock. A quick check on your markets this morning because they are off. Thank you, Oracle, I guess, for that. That's why the NASDAQ is down 1.2%. But NVIDIA is also sinking this morning, too. A lot of the AI trade caught up in the concerns about overextending of spending without getting the revenue back. The S&P down 0.5%. 10-year yields continue to fall after yesterday's Fed cut. They were at 4.16 earlier in this week, now at 4.11. Oracle shares down more than 14.5%, Matt.
Yeah, NVIDIA really getting hit, really dragging down the market in itself, off 8% over the last month. Let's get a look at some of the single stocks moving this hour. CEO of Microsoft, Satya Nadella, saying the company will unveil a new AI model tomorrow that is, quote, going to take agents to the next level.
Sounds exciting.
I'm excited about that.
But can it make you a Disney film? Disney has agreed to invest $1 billion in OpenAI and license its iconic characters to Sora, that is OpenAI's short form AI video platform. That still makes like some pretty weird videos where like hands disappear and weird ghosts appear.
That's what happens when you use virtual backgrounds. Eli Lilly's new obesity shot helped patients lose almost a quarter of their body weight in a late-stage study that exceeded expectations, and some patients dropped out because they were losing too much weight.
What an interesting problem to have. Okay, coming up, we're going to talk private credit. We catch up with the founder of Strategic Value Partners, a $22 billion credit firm that focuses on distressed and special situations. That's Victor Khosla. Stay with us for that after this break. You're watching Bloomberg TV.
The fundraising environment was very good. A lot of people rushed in. And you had a lot of smaller players that were able to raise a small amount of capital with a small team. And at this point, they probably don't have the same ability to raise capital. I think the industry will continue to migrate to the market leaders. We think the trends will continue to be strong. You may see ebbs and flows for a quarter or two, but we're going to have a record year in credit fundraising this year. I'm not in the business of predictions, but it wouldn't surprise me if we have a record again next year.
Blue Owl co-president Craig Packer on his outlook for the fast-growing private credit industry heading into 2026. Let's continue the conversation. I'm pleased to say joining us now is Victor Khosla, founder and CIO at Strategic Value Partners, a $22 billion credit firm focusing on distress and special situation investments. Victor, what a year it's been for credit on so many fronts. We have a lot to talk about. But look, this is an industry that's been in fierce defense of itself. Blue Owl being one of those ones, really vocally coming out and saying, you're wrong, Jamie Dimon. They're not cockroaches. Things aren't wrong. You maybe side a little bit more with Jamie Dimon in this argument.
We're living in a world where it's truly a K-shaped world. So tech, data centers, financing them, building them, going out and where these valuations are, that is a very hot market. There's a whole other piece of the industry, the bottom part of the K. So when we think about it, chemicals, in just an extraordinary down cycle, anything associated with autos and construction and manufacturing. Manufacturing has been 8 months of negative numbers in US manufacturing for the last 9 months, right? So when you look at that world, and forget even cockroaches or otherwise, right? When you look at the fact, I think the point I'd like to make more is we're living truly in a K-shaped economy. And what is happening in that lower part of the K, actually it's focusing on figuring out solutions around it is probably one place where there should be a lot more focus.
Right, not enough light there because we're all looking at the spotlight on the data center build out, right? Yeah. Are we seeing, do you think, a recession in a big piece of the economy?
Parts of it are recessionary. You know, when you have 9 months of PMI numbers, producer manufacturing numbers, negative in the United States, that tells you manufacturing is recessionary today, last 9 months, right? But I don't think it's so much even, I happen to think, please, I'm not an alarmist. I don't think there is some crash coming, there's some huge recession coming or something. That's not our base case. But in a world where you have so much of the leveraged credit market, which is in those deals where, and these are deals done pre-2022, interest rates are so much higher. The earning numbers are flat to down in some of these businesses. I think the focus on trying to fix it, how much capital needs to go in there to kind of fix it, right? And how do you kind of solve some of these issues? I think that's where, Matt, I think you've got to put light on.
Victor, can I just ask, because manufacturing, one of the key goals of this administration, I've talked to Scott Bessent about it, and obviously Donald Trump wants to bring manufacturing back to America. That's the point of his, at least partially, the point of his tariff regime. Is the administration helping this situation if manufacturing is in a recession? I mean, they've been here for a year. Are they doing the right thing?
No, they've started. They're trying. It takes a while to turn around these aircraft carriers.
Right.
Right? It doesn't kind of happen quite like that.
So with the one big beautiful bill, you think that's going to add some stimulus, some impetus to this?
It's a down payment.
Yeah.
Right?
And you know these really well because this is part of what SVP does so well. You look at this stress and you find ways to put capital to work to make it look better. But this is an industry, Matt and I have had so many private credit conversations where managers will come in here and they say, we're investing in the new economy. We're in that up part of the market. We're doing really well. Do you think that this is an industry that either hasn't fully grappled with or just isn't admitting what things really look like underneath the surface?
Look, everybody loves to talk their own book, okay? So who am I to kind of cast stones at anybody, right? But what we would tell you is, after you had First Brands happen 2 months ago, we've always had a relatively high level of defaults in high yield. If you look at Moody's statistics, they tell you default rates are 5%, 5.5%. That's 1 out of 20 companies, right? That's a high level of defaults. But something else happened starting about 2 months ago. 2 months ago, after First Brands, there are 15 deals we are tracking with debt greater than $2 billion, some of them with $20 billion of debt in the high yield universe. And the senior debt is now trading at prices under 70 cents. Right? So I think there's whatever you saw happening there, you know, we did, as a group of investors, we all made investments pre-2022 when interest rates were zero. Interest rates are higher. Some of these underlying businesses are sluggish. And as a result of that, some of these capital structures need to truly get fixed. 70 cent, under 70 cent senior debt means the company is essentially a zombie company for right now, right? And we've got to kind of start to attack it. And that, by the way, I think, as you know, that's our focus. We provide capital. Look, some of these will end up as restructurings, sure. But at the same time, so many of these great businesses, some of these are really great businesses just over-levered. They need capital they need preferred capital, junior capital to go out and kind of restructure that balance sheet, right? So to our way of thinking, there's just a whole bunch more opportunity.
I would say First Brands isn't a one-off, is also what you're saying.
It is. You know, to talk about fraud, to talk about something, all the different...
Because that's what most people say. It's fraud, it's idiosyncratic, there's no other cases of it.
But also that it's a great business, right? Bruce Richards was sitting right where you are, and he said it's a great business. And I buy First Brands products for my cars, you know? Like,
can I tell you, I'm not going to debate First Brands' great business or bad business.
Yeah.
The balance sheet obviously was a little exaggerated, if I'm just being polite, right?
And the super senior debt is trading at what, 60 cents?
I think 50 now.
Yeah. But you're on top of it as I am.
So you're involved in First Brands, if I'm not mistaken.
We are now, and I have to just be very careful about it for that reason. But put First Brands on the side. The 15 companies whose debt has fallen between $2 billion and even $20 billion in the last 2 months, we don't think there's fraud here. They're just over-levered. Just way over-levered, and these deals done pre-2022. And I think that's the part we've got to kind of work through and fix. For manufacturing to really get better in the US, you've got to fix these zombie capital structures, the ones which we've created.
And for you, it's an opportunity, right? As we've discussed, when you see good companies that just need more finance in there, regulators might look at it differently. And there's been a lot of attention in Washington, D.C. Elizabeth Warren and another Democratic representative have been talking that credit needs to be stress tests like the banks. FDIC changing rules on leveraged loans that make things more friendly to the banks. Do you think the tide is really changing, where regulation is now focusing on alternative lenders versus the banks?
The alternative lenders have had a free ride, right? The banks they used to compete with had one arm tied behind their back. And the private credit guys were able to kind of, you know, to me, from a distance, we are not in the direct lending business, okay?
Right.
But so I'm a little distant from it. But you can see now the banks which had one of their arms tied behind their back, that arm's being freed up, right? So there's a little bit more competition than there was.
But when there's more competition, often that leads to standards that get a little bit looser, trying to win over that. That sounds like maybe not the healthiest thing, actually, to have that competition back.
Yeah, you know, in credit, we have cycles, Dani. We're going to have a little cycle.
Where are we? Where are we right now in the cycle?
Spreads are close to record tights when you look back over 20 years. They've been right around kind of 300 odd basis points, give and take, right? Give or take. Those are really, really tight spreads, just in terms of where we are. So look, we're poised. You just look at high yield over time. You know, spreads can blow out to 600, 800, 900 over. And that's sort of what happens when in a recession. I don't think we're in a recession in the next year or two. Don't get the wrong idea.
Right.
But please, I think our view would be you're lending today with really tight spreads. The amount of new issuance which is coming into the high yield market, all this data center stuff you're hearing about, well, guess what? The hyperscalers are coming to borrow in the high yield. The amount of supply is just going to increase a lot. I think, to our point of view, the pressure on spreads is likely to go up, even barring a recession. The pressure on spreads to clean up all the stuff I was describing, all that just requires capital, and those spreads will they will have to kind of widen to accommodate it.
Victor, can I just ask, you're, I mean, not in the direct lending business, but you're a pioneer in the distressed credit business. And Howard Marks is another who was just on surveillance. He said he thinks that these are healthy markets, healthier than they were in 2000, but that the Fed shouldn't be necessarily moving rates much more at this point. What's your view on what the Fed should be doing?
Yeah, beyond my pay grade.
It is not. If anyone gets paid enough to talk about this, it's you.
Look, you're hearing me describe some real caution.
Yeah.
Right? So in kind of a cautious market like this, where inflation isn't quite licked, I think caution would suggest just go easy. Don't supply more fuel to that fire, right? But I'm a little bit of an old-fashioned, I'm a little more cautious.
Victor, you're one of the best. This is why we like having you on. Please come join us again very soon. Victor Khosla, founder and CIO at Strategic Value Partners. Still ahead, Lumexa Imaging makes its trading debut today. The CEO will join us live from the NASDAQ. You're watching Bloomberg Open Interest.
Get a check on what's going on in markets. Almost an hour into the session, we're looking at the S&P down just 0.2%, so clawing back some of the points it's lost. The Nasdaq down just 0.75%, and that's because Nvidia and Oracle are weighing on it. Coming up, Lumexa Imaging raises nearly $500 million in an IPO. We'll speak to the company's CEO next. Lumexa Imaging raising $462.5 million in its IPO. The company, which operates 184 diagnostic imaging centers across 13 states, is set to trade under the ticker LMRI on the NASDAQ. Joining us now is the company's CEO, Caitlin Zulla. So, Caitlin, congratulations on the IPO. I guess my first question is, what do you use that money for? Nearly $500 million. How do you intend to put it to use?
Thank you so much, Matt. I'm so honored to be here, and what an exciting day for Lumexa Imaging. Diagnostic imaging is a rapidly growing landscape. It's a $140 billion TAM with a 4% growth CAGR, all driven by advancements in treatment paradigms that require access to advanced imaging. And so with our IPO proceeds, we'll have improved cash flow that allows us to seize the moment and continue to invest in our current centers, as well as add new facilities to our portfolio.
What about an AI strategy, Caitlin? Everybody needs one, regardless of what your company is, but especially with imaging and radiology. Where are you going moving forward with the technology?
I completely agree, Dani. AI is important in every part of healthcare, but especially radiology. If you ever needed an MRI, you would need to go to a facility that's got an expensive machine behind magnetic safe walls, that has a tech who's certified to put you into the machine. That's hard to disrupt, but AI makes every part of that process for us better. How we get more patients, how we improve the efficiencies of our machines and our centers, how we support our radiologists in doing the reads, and then how we continue to bring efficiencies to things like revenue cycle and our call center.
So what are you looking at in terms of disruption? Because this is an industry where prices just continue to absolutely soar, and specifically, MRI is a place that is extremely expensive.
I could not agree more. And one of the best parts about Lumexa Imaging is that the centers we operate are 60% lower cost than a hospital outpatient department. And that is a meaningful savings for our patients, and a big reason why we have a patient net promoter score of 91, which is remarkable in healthcare and really generally.
Caitlin, one of the reasons I was so excited to talk to you was there was this study in Europe from over the summer that I have not been able to stop thinking about. And it was about doctors detecting colon cancers after colonoscopy and looking at the imaging. Basically, 28% was their success rate just on their own, doctors. You add an AI, the AI assistance bumps it up a little bit, and then they completely take away the AI. And doctors did much worse than they were doing before the assistance of AI. In other words, they became reliant on it. In this future where we are using this really helpful technology, what does it mean for generally de-skilling? Is there a real risk that a medical community becomes over-reliant on AI?
Gosh, at the end of the day, technology makes us better, whether it is how we do analysis in Excel or whether it's how we end up looking at our images. Our subspecialized radiologists provide incredible high-quality care, and our goal is to make it even better for them by continuing to think through what are the AI advancements that will drive value to them and, most importantly, our patients.
I want to ask about policy, Caitlin. We have evolving Medicare rules. No one really knows what the Obamacare subsidies are going to look like over the next few years. What kind of reimbursement risk or what kind of reimbursement opportunities do you see?
Yes. So Lumexa Imaging, our centers are the value-oriented center in any market. When we have conversations with payers, they are delighted to see us into the market because we're providing the exact same service, the same machines, the same scans, often even the same radiologists as the hospitals, just at a 60% lower price point.
Can you be in the same network? If I go, I'm a Mount Sinai guy. I don't know if that's a HIPAA violation, me saying that out loud.
I don't think you can violate your own.
I like to be in the network because my doctor then can see in the same website all of the data. How do you deal with that issue?
Yes, Matt. We work with our health system partners and our referring physicians to make sure they always have access to your images, to your radiology read reports. And we have been blessed with 8 incredible joint venture health system partners that are also helping us continue to think through how do we expand, serve their patients, and integrating with their medical records is a huge part of that solution.
Not too dissimilar, Caitlin. It does feel like a world where people are increasingly price sensitive, both on the payer and on the patient side. How do you protect margins as that evolves?
Absolutely. So when we think about meeting our patients where they are, we have incredibly flexible schedules. We will have within our centers hours typically 7 to 7, often even later in the day. We will do weekend shifts. And at the end of the day, when we're able to provide more scans to more patients, that drives our financials.
Caitlin, what was your thought process before going public or while you were going through this? Because a lot of companies now choose to stay private longer. IPOs we're looking at a little bit of a resurgence, but it still is a complex issue that you need to deal with your shareholders. How did this work out for you?
We had such incredible discussions through the entire IPO process with investors that saw the value that Lumexa provides, understood the dynamics in our rapidly growing industry, understood the growth opportunities in front of us, and they were really excited to support us. And being public allows us to accelerate what we're already really good at.
Hey, Caitlin, congratulations on the IPO. Wonderful to talk with you just as you're there on the exchange floor. Caitlin Zulla of Lumexa Imaging. A quick check on your markets this morning, continuing to be weighed down by the earnings coming from Oracle. They're off some of the lows, but still down a hefty 13%. It's that real fear of spending that's been picking up for them. $50 billion is their projection. So the NASDAQ down 0.8, the S&P down 0.2. Yields continue to fall. We are at 411.37 this morning, Matt.
Get a look at some of the single stock stories. Investors are going to get another read on the AI trade when Broadcom reports. After the closing bell today, Broadcom has been one of the hottest stocks in the market this year. Avgo is the ticker. You can see today it's down 3.2%. But what they say on Romaine and Katie's show could change everything.
Could change the world. Can't wait for that conversation. Coca-Cola CEO James Quincy stepping down, will be replaced by COO Henry Braun at the end of March. Shares fall just under 1%.
And Altria's CEO Billy Gifford has decided to retire effective May. The CFO Salvatore Mancuso will take his place. Those shares moving up 0.5%.
Coming up, some of the other earnings we're going to be getting after the bell include Costco. We'll also talk other retailers with Sucharita Kodali, Forrester Research retail analyst. That conversation to come. This is Bloomberg Open Interest. We're going to get another read on the consumer this afternoon. When Costco reports results, analysts will be paying close attention to traffic trends, margins, and membership rates. The stock has underperformed the S&P Consumer Staples Index this year. Joining us now, Sucharita Kodali, retail analyst at Forrester Research. Sucharita, we want to talk to you about retail in general, but Costco has always been really confusing to me. The fact that it has underperformed, because you'd think it's one of these kind of value offering type companies that would perform pretty well. Why has Costco been a chronic underperformer?
That's a good question. It has fluctuated a lot in the last year. And it doesn't make a lot of sense as to why. They are one of the most transparent companies that is publicly traded. They release monthly reports on their sales, and their sales to date, especially in recent months, even in the month of November, has outpaced not only their own performance through the course of the year, but retail overall. So it is a little bit puzzling. I think that some of it could just be that maybe its investors are a little bit concerned about the state of the economy and are taking gains while they can. That's likely what is happening, because the company otherwise is a good performer and it executes really well.
Sucharita, we see a lot of consumer goods companies eating tariffs because you don't get consumer goods inflation that you would expect with these kind of numbers. Where are you seeing that as the case? I mean, are these big box stores doing the same?
Well, there is one of the elements that seems to be hidden in the inflation numbers, because the inflation numbers are extremely structured and they pull from price checks and high-level figures around just how prices are changing. It doesn't necessarily look at quantities and purchasing power parity. So even though inflation numbers may seemingly be in a better place than they were even a couple of years ago, we have a factor, particularly in mass, which is the phenomenon of shrinkflation, where you have consumer packaged goods companies changing the size and the quantity of what they are offering, reducing some of the pricing on that packaging so that the optics look like the product is at parity. But when you look at it on a unit per unit basis, the price is actually a little bit higher and the consumer is getting less for every dollar spent. And I think that when we look at consumer confidence numbers, which are at record lows, that may be part of the factor. I think that we've been blaming a lot of it on the political environment or the news cycle. But I think this phenomenon of shrinkflation, which could be tied to tariffs in some cases, is really the factor that's driving consumer confidence down.
Sucharita, I thought this was supposed to be an environment where the consumer is more discerning than ever. How are companies still doing shrinkflation or any of these kinds of practices that you would assume would get some pushback from especially value-conscious consumers?
Right. And it is, I think, where we see the overall retail spend numbers are growing for exactly that reason. But the discriminating consumer is showing up in those consumer confidence numbers, where they're unhappy and they are very concerned for the future, and they're concerned about their ability to not only have their wages meet their needs, but their ability to continue to purchase these essential goods and get the same value for money that they may have received in the past. So I certainly think that while these value merchants, it could be everybody from the dollar channel to mass merchants like Walmart, and of course the warehouse clubs like Costco and BJ's, will nonetheless be able to capture some of that share. The shopper is a little bit cranky in their spend, and understandably so if they're getting less for their dollars.
It's so funny that we see, in retail, higher income consumers gravitating down, and obviously those in the lower quintiles are hating life. Whereas we just did a story on, JetBlue is putting a new ambassadors club lounge in its terminal at JFK, and American Airlines is aiming more for the higher end segment. Like in travel, in airlines, everything is going so well. Is that just indicative of the K-shaped economy? Is that just because only rich people are buying those services?
Yeah, we've certainly been seeing a lot more of the elite clubs, whether it's from Chase Sapphire or American Express or others infringing on the airport for sure. But we've seen a little bit of a puzzling story in retail when we look at the higher end retail brands, whether it is Nordstrom or Saks or even the branded manufacturers like a Louis Vuitton or the Kering Group. It's a little bit more of a mixed story. And some of that is largely tied to immigrant shoppers, or not immigrant shoppers, but foreign shoppers or other foreign markets like the Chinese consumer, which has been weighing heavily on some of those luxury brands. So there are other factors. It could very much be when you dissect which shoppers are shopping at the high end. The American high-end shoppers are doing well, but those brands aren't doing well collectively because the global shopper may not be doing quite as strongly. Whereas for the airlines, the bulk of their transactions are going to be either business travelers or domestic affluent travelers.
We're looking at just the share price of Ulta. And Sucharita, that reminds me, coming out of COVID, the thing in retail that did super well was beauty. All of these different companies that had beauty offerings are really trying to lean into them. There are trends going on there with teenagers on TikTok buying more skincare than that anybody without wrinkles would ever need. Is that still happening? Are these beauty names still the big winners in this environment?
Well, when you look at how Ulta has performed this past year, it certainly seems that the consumer is absolutely purchasing those products and continues to do so. The joke about COVID was that it was all those people on Zoom cameras that wanted more makeup, so that they were spending money instead on their apparel or their wardrobes. They were spending it on how they looked on camera. But that trend seemingly continues to go on. And whether it is teenagers or whether it is that in recessionary times that consumers will often purchase these more affordable goods, it's that lipstick effect that the Lauder family had coined decades ago, that it's a category that does well even when the economy isn't doing as well. That is absolutely a factor that could be in play right now.
Sucharita, great to get your take on this industry. We hope we can have you back again soon. Sucharita Kodali there of Forrester Research. Coming up, President Trump reiterates his criticism of the Fed following another 25 basis point rate cut. Plus, the battle for Warner Brothers carves up the country along political lines. We'll discuss it all next. This is Bloomberg Open Interest.
The head of the Federal Reserve is a stiff. He did a rather, I would say, a rather small number that could have been doubled, at least doubled.
President Trump criticizing Fed Chair Jerome Powell after the central bank cut interest rates by 25 basis points for the third time in a row. Joining us now is Bloomberg senior Washington correspondent Saleha Mohsin. It's great to have you here in New York. Thank you so much for joining us. What do you make of the Fed's move yesterday? You talk to all of these people. You interview all of these Washington and finance bigwigs. So how did it turn out?
It looks like whoever has the chair job next year after May, when Powell steps down as chair, is going to have a difficult job. You can already see that Jerome Powell is struggling to get consensus on the board. He had to kind of force that quarter point cut through, and Trump is still not happy. And we've also heard from President Trump through Politico that whoever takes the chair job, their litmus test will be cutting rates soon without looking at the nuance that you need a board to fall behind you.
Why are we still in the dark, or maybe not in the dark? Why do we still not have an announcement from the president about who that's going to be? The timeline keeps getting pushed out. It was around Christmas. Maybe it's in the new year. All the signs were pointing towards Kevin Hassett. I mean, is that just not where we're going? And if it is, why haven't we gotten the announcement yet?
Part of it is that we don't need an announcement right now. We just think we're going to get one because Trump himself has said sometimes it's going to be in 3 or 4 days. Since June, we've been hearing, and I've made my decision. It's coming in a week or two. And now he's saying before Christmas, before he was saying after January. They don't really need one to start heading to the Senate and toward that confirmation process until January, maybe even February. That's part of the reason. But it looks like things are picking up. Trump said that he was meeting with Kevin Warsh, who is one of the contenders for the job. More interviews may happen, and we're hoping that there's an announcement in the next week or two.
The terminal rate, at least according to the world interest rate probability screen on the Bloomberg terminal, has been floating a little bit higher. Now it's getting above 3%. And we were just talking with Victor Khosla. Lisa on surveillance talked with Howard Marks. And these, whales in credit are saying the Fed needs to be cautious. Like, we're looking at a potential problem with inflation. So what do you think the smartest people in Washington are thinking?
Well, we're seeing that play out on the Fed board and across the Fed regional bank presidents, right? We have a great story out by our colleague Katerina Sarieva that talks about how there's a silent dissent going on, not just by the voting members, 2 or 3 of them saying we don't back this quarter percentage point cut, but also regional Fed presidents who don't have a vote but do have a voice to be able to say that we don't agree with it. It's a confusing economy right now.
Well, it's also confusing makeup when it comes to those presidents, because Scott Bessent himself was talking about this idea of putting tests in that require to say, do you live in the district that you represent? How do you see that issue evolving in 2026?
Once we have a chair in place, I think we'll be able to get a better sense of what kind of authority that chair is going to try to wield in bringing in some of the Trump-driven ideas to the Fed. Right now, all of that is driven by the Fed. The Fed has its own rules. The president does not get to choose regional presidents. And Bessent said himself when he made those comments last week or earlier this month that it would probably take an act of Congress to make those changes.
But President Trump has continued to indicate that he might like to clear the decks, right? And we hear from economists that could be an option. What levers does he have to pull to do that?
The chair would have to find a way to rally the board around him. And that's where we're seeing Trump thinking about the Federal Reserve, the board, in the way one thinks about a Supreme Court, that conservatives have a majority, and so you can kind of guess the way decisions are going to go. He's applying that same logic to the Federal Reserve, and it's not necessarily wrong. Christopher Waller, Michelle Bowman are rate-setting voting members on the Fed board in Washington. Both of them were selected by Trump and confirmed by the Senate, and now they've been interviewed for the current Fed chair opening that's coming up in May. You could say that's either currying favor or just showing that there is a division on this board. There are Democrats on the board and there are Republicans on the board.
By the way, what's the latest with Lisa Cook? I feel like we haven't heard a lot happening there. Are things developing?
Well, we're waiting for either January 20th or 21st. We're going to hear oral arguments on that, and that will be a big deal for Fed
She's
watchers.
the dove that the president wants to dismiss, which kind of tells you what he wants on the FOMC. All right, Saleha, great coverage. Love the podcast. Your Trumponomics podcast last week was fantastic. Hope you keep coming back to New York and visiting us. Saleha Mohsen, their senior Washington correspondent. Let's get a check on what's going on in markets right now, an hour and a half into the session. We have small caps gaining, but the S&P 500 off about 1/3 of 1%. Still at 68.64. I mean, President Trump just tweeting out, hey, the stock market's at record highs, and it is almost there.
As of the close yesterday, 0.06% away from record highs. If things continue on the way that they are this morning, we won't get there, but we're still very close.
In the UK, near enough as, damn it, is that what they say?
I have no idea.
Coming up tomorrow, Ulrika Hoffman-Burchardi of UBS joins us, Cameron Dawson of New Edge Wealth, plus the CEOs of Wealthfront and Brown Harris Stevens. There is another person, we just didn't get her picture. This is Open Interest.